Awesome. Welcome back. Today we are very lucky to be joined by Matthew McLennan, who leads the Global Value Fund here at First Eagle Investments. Thank you very much for joining us, Matt.
It's a pleasure. It's great to see you both.
Thank you, Matt. So we'd like to start with the background of our guests to get some insight into sort of, how they all started out. So you were born in Rabaul, Papua New Guinea, which is quite an interesting place for a, quite famous investor to grow up in. And then you eventually grew up in Queensland. How'd that upbringing sort of, help shape you and your background?
So my parents were in New Guinea for adventure. This was back in the late 60s. And I guess that's left me, in a sense, always a little open-minded to being more global in outlook and where I've lived as opposed to just locally oriented. And I credit that to my parents to a certain extent. And I think perhaps what was more formative is when I moved from New Guinea to Australia, we ended up living in a little town called Montville. And it was a beautiful spot, but at the time, it's hard to believe it's only an hour and a half outside Brisbane. There was no electricity where we lived for about 7 years. And so that, informed a different way of living in a sense. We had a house full of books, and the love of learning was instilled, very early in that kind of environment. But also, what I really recall about my childhood was my mother was an avid gardener. And it always seemed to me a bit of an exercise in futility. Because there was a problem, there was seasonal issues, there were pests, there were everything that could go wrong seemed to go wrong. And it ended up becoming an amazing lesson for me because there was a farmer who lived next to us who would mow his lawn every week. And there was a guy living in a lodge behind us in the rainforest who just let the forest grow on check. And so there was essentially 3 parallel models going on at once about different ways to sort of steward an asset, if you will. And when I would come back decades later with my kids to see my parents' place, the garden that my mother had curated was just beautiful, resplendent. And it had been curated through selectivity and patience, whereas the block of land next door that was mowed every week continued to be mowed, but there was a lot of activity and not much to show for it over decades. And the house in the woods behind had issues I understood from like fire and things like that because you didn't have the natural fire barrier or anything like that. And so to me, it served as a kind of metaphor for investing more broadly, growing up in that environment.
Yeah, it's fascinating. Wow. And I guess, what was your first sort of foray into investing when you were younger? Like, were you investing during school or,
Well, I think one of the things that tends to happen in a field like investing is that you're blessed if you make all the right mistakes early on.
Yeah.
And one of my first forays was I had a math teacher in grade 11 who thought he was able to use Elliott wave theory to predict the exact movements of the Dow Jones. And he thought it would be a great idea for us as grade 11 students to trade futures on that. Now, you can't really do that thing nowadays, but you can imagine what the results were. And it made me realize that actually, need to get more analytical about this. And I think it was also a time back in the 80s when the corporate raiders were going gangbusters and using leverage, doing a lot of M&A. And it seemed like they discovered some elixir for wealth creation, but a lot of those companies went belly up ultimately. And so I think being exposed to the wrong things early on is a real gift. And it gives you an opportunity to invest in learning from those mistakes. And so really it sort of drove me throughout college and beyond to focus on fundamental investing and understanding valuation and things of that nature to invest in a more sound and prudent manner.
Oh, that's very comforting to hear given my recent performance, Matt. So
I think Charlie and I made our fair share of mistakes early on, so hopefully we from here be a bit more prudent as well.
No, exactly. And I guess sort of building on that early investing experience, it's our understanding your first role was at QIC in Brisbane back in 1991. So ultimately, I think in that role, you ended up, and it sort of ties back to your point around a global mindset, you're overseeing international equities there. Can you speak to that role?
Yeah. So that was really a great opportunity for me once I finished my honours degree at UQ, and my thesis supervisor at the time, Don Hanson, who went on to run quantitative strategies in Australia, was a tremendous mentor. And he took a job at QIC. He hired me, and I think what I learned early on at Queensland Investment Corporation is that through the fact that we would parse out part of the international equities to third-party managers around the world, you realize early on that there are a lot of different ways to skin the cat in the investment world. And so I was exposed to the whole gamut of managers, from value managers to growth managers, different time horizons, different approaches, quantitative, qualitative. And so that opened my mind to the array of ways in which one could invest. And I think pretty early on, I sort of figured out that it's really a matter of individual choice to end up investing in a way where you're most comfortable in your own skin. You have to find that.
Yeah. And then, so did you get that chance? So your next role was at Goldman's in Sydney and then London.
Yes.
Did you sort of move into that more value-oriented mindset in that role?
So my first year at Goldman was actually on the banking side of
cool.
Goldman. Which was a great learning experience, a lot of hard drive, and within about a year, I transferred from Goldman Sydney to New York on the asset management side, and wound up in London in asset management. And it was really at Goldman where I sort of dug deep into the world of value investing. Now, I'd already learned the theory of value investing back in university under Don Hampson, where we were studying market pricing anomalies and things like that, and I had a leaning that way. But one of my early mentors at Goldman, Paul Farrell, had worked for Lou Simpson at Geico.
Oh, wow.
And so he instilled in me early the lessons of Warren Buffett. And at the same time, I had a different mentor, Mitch Cantor, who'd come from Bernstein before joining Goldman, who instilled in me the importance of understanding margin cycles and the normalization of earnings. And so I got really great value mentors early on at Goldman.
Yeah, it's funny that, going from investment banking, trying to drum up any acquisition you can sort of a lot of the time, and then going to that more value-oriented way straight away at Goldman's asset management side. Yeah, interesting.
It's interesting because the way I sort of think about it is investment banking in some ways is a kind of a cross-sectional exercise in valuation. You're looking at the value of an asset today relative to a comparable group of companies, and you're trying to sort of get the psychology of a transaction to work. Whereas in investment management, it's much more of a time series approach. You're really thinking about how a business is going to evolve through the passage of time, and how its valuation profile might evolve in that context.
Yeah. Are you grateful for that sort of period you spent, in the investment banking team at Goldman's, in terms of giving you that appreciation for the slight nuance in psychology there?
No, it was a great experience. I wouldn't trade it. I think even beyond just the kind of analytical dimensions of what you learn in an experience like that, you learned how hard you could work and what you could actually accomplish if you put your mind to it. And I remember one of the partners at Goldman telling me once, if you want something done, give it to the busiest person. And that always sort of stuck in my mind, that people let a task expand to fill the space that they have. But if you're busy, you really focus on the essence of something. And so that was a lesson early on from banking, above and beyond the analytical side of things.
Yeah, no, fantastic.
Fascinating. And then, I guess, moving into your subsequent move to First Eagle in 2008, right as the GFC was unfolding, I guess probably no better time to be joining a value-oriented fund, I'm guessing. But do you want to, obviously still crazy time to be joining a place like that as well. So do you want to speak to that time and joining?
So I mentioned earlier on that part of achieving one's goals as an investor is to figure out where you're going to be most comfortable in your own skin as an investor. And I think I had an amazing experience at Goldman, and I was working as part of a team that not just looked at equity decisions, but currency valuations, the price of risk in fixed income markets versus equity markets, commodities, versus other risk assets. And the First Eagle opportunity was unique because all of those decisions were made inside one fund. And I'd admired Jean-Marie Everyard for decades. I came across him originally in the 90s. There used to be a publication called the Outstanding Investor Digest.
Right.
And he was interviewed back then. And we had some name overlap. And so, when the opportunity surfaced to join First Eagle and head the team, the global value team, it was something that just spoke to me. And It was an interesting moment in time, as you alluded to. I started the week before Lehman filed for bankruptcy.
Wow.
Right. Far.
And that was a gift to join and run a team at that time, though, because the mistakes that people make in investment underwriting often creep in late in the cycle where risk perception is low. Yeah. And people are focused on what they have experienced in the rear vision mirror, and so a lot of stocks have gone up a lot when you're at the peak of the cycle.
Yeah.
And perhaps your risk tolerance is more than it should be. So taking over the management of this business with a great team in the middle of a crisis was terrific, because you basically had everyone aligned around the same goal of prudent underwriting in a manner that may not have happened if you took over in a more frothy market environment.
Yeah. As you sort of alluded to before, Jean-Marie Eviard, very famous investor, and sort of, handpicked you to be his successor and then run the team. What do you think he saw in you that made him comfortable sort of handing over the reins?
And how did, I guess, you get yourself in a position where someone like him, recognized your skills?
So firstly, I'm extremely grateful to have been afforded the opportunity. It's been just a wonderful learning opportunity and a great group of people here at First Eagle, and so it's been an amazing privilege. And I think in my discussions with Jean-Marie, one of the things that he mentioned to me that got him comfortable is I had been running some small and mid-cap value strategies with some fellow portfolio managers back in the late 90s at Goldman and early 2000s, and we were willing to be short social acceptance at the time. That was during the internet bubble back in 1999.
Growth strategies were going like that.
And we didn't get drawn into that mania. And so we, in those funds, had positive absolute returns in the subsequent years when broader markets were very weak. And I think that had been the experience of First Eagle. And I think that weighed heavily on Jean-Marie's judgment. And I think as well, when you speak with someone like Jean-Marie, what you learn pretty quickly is there's the analytical toolkit that you need as an investor, but temperament is also very important. And I think whether it was me or someone else, they were looking for someone who would be patient as an investor, would invest with a dose of humility. Otherwise, you don't demand a margin of safety from your investments unless you have some degree of humility and respect uncertainty. And so I think Jean-Marie weighed heavily the temperament variables as well.
Yeah. And it ultimately, in my head, I'm thinking, it must have been so challenging when you see all these other funds, going crazy through that bubble. But it probably comes back to your point around being comfortable in your own skin, knowing that just wasn't you guys.
Yeah, I think that's right. I mean, ultimately, it would have felt uncomfortable going into those securities at those prices, and so it wasn't just high prices for those securities. It was that the management behavior in many of those companies was very aggressive, and some of the accounting choices being made were very aggressive, and so it was almost like against my DNA to deploy capital into those situations, and I think that could be a flaw in different parts of the market cycle. And there's many great investors who have been selective in the growth world and made tremendous fortunes for the clients. And so one of the things that's important to understand in investing is no one has a monopoly on the truth. But you have to know what you feel comfortable doing.
Yeah. And just at risk of laboring the point, but when you sit there and you do see these other funds returning, 40, 50% in a year, and, you're returning maybe a lot less than that during those times, was there ever a time where you were like, maybe we do need to own X, Y, Z? Or was it just, you just stuck to your guardrails?
I think at those moments, actually, when I sort of reflect back on it, I focus mostly on the arithmetic of our investments. So to the extent that you have a group of securities that don't participate in a mania, on the one hand, yes, it's a pity that you missed out on that upside. On the other hand, when you sit back and think about those investments, they're going to have higher free cash flow yields than the richly valued companies. and they may grow at a measured pace over time. And so I think what gave me comfort was the ability that I had line of sight to a group of businesses that I could see a double-digit return from, just through arithmetic. And I just had to wait. Yeah. Just like, my mother in the garden had to wait. And with some of those other securities that had gone up a lot, they had only 1 or 2% free cash flow yields. They would have to grow 10x to get you to a reasonable free cash flow yield over time. And so the market was pricing so much that I felt good in waiting. And in investing, as in life, happiness is outcomes divided by expectations. And expectations were just too elevated in some of those things.
True.
Yeah. Fantastic. And I guess sort of coming to a more contemporary, role that, or your more contemporary position today as a co-head of the global value team and PM across global, international, US value, and a whole range of different securities that are encumbered by that. How do you divide sort of your responsibility and what remains sort of your core focus in your role today?
So one of the decisions I made early on at First Eagle is, and I believe strongly in this, is that you're going to do well for your clients if you surround yourself by great people. And so we did a fairly heavy amount of hiring early on in my tenure at First Eagle, and many of those individuals have grown in their responsibilities over time, from analysts to senior analysts to portfolio managers, and into management responsibilities on the team. And so that's been incredibly rewarding for me to see the team growing years together, and the bench to really deepen. And I think if you surround yourself with a lot of people who have very informed perspectives, but their own specializations, you get to better judgments. And so I would describe the process of investing at First Eagle as being quite distributed. We have a lot of senior investors on the team, and the funds have some amount of overlap. So the global fund is our mothership, and it can go wherever, US, internationally. It can own bonds episodically if it gets equity-like returns. It has a potential hedge in gold. The other funds tend to be carve-outs, if you will, of parts of the global fund. So it could be the international or the US value. And there'll be some overlap in the holdings that are jurisdictionally linked, but those other funds that may be smaller could have smaller idiosyncratic positions that fit the mandate of the strategy. But the way to think about First Eagle is the global fund is the mothership, and the team and the research process are distributed on a really deep bench.
Yeah,
fantastic.
Well, I guess when your investable universe is so large, like you're a global value fund, I guess what's interesting to us is like how you do that first sort of screen. So because it's important, I think, as you've sort of said before, that your investable universe, such that you're not spending hours trying to find that, and initially you've got a set of companies that you know that they're the types of businesses we like to invest in. Yeah. Do you want to speak to that process?
So if there's one thing that kind of unites the weight of our holdings, it's this idea of scarcity value. And what that means in terms of the filtering of a company that would be of interest to us and coming into the portfolio is that we focus on the business first, and then we assess value. Yeah. And we focus on businesses that have some kind of incumbency advantage typically, and those businesses are scarce. And it could be a company that controls certain real assets. So if we look out the window today, you imagine you controlled the George Washington Bridge, and it's one of the only ways across the Hudson. That's an asset that's going to have pricing power over time and has natural duration. Yeah. But that same analogy can extend to an owner of resources where they might have basin density and be a low-cost producer with very long duration resources, or it might be just a real estate company that has CBD real estate which has premium rents, so they generate more cash flow through a cycle. So there's certain companies we look for that have incumbency in the world of real assets, and that would be 20-25% of the portfolio. But the weight of what we do is companies that have scarce intangible assets. And that would be a moat, for example, built around an R&D competency. They might be a world leader in the creation of a precision product, for example. Like, we own a company that has 60% market share in global syringes and catheters, for example. Or it might be a company that has an iconic brand that's been around for a century plus. So it has a degree of pricing power. So think of the holding company for, say, Cartier, the jewelry company, for example. And there are other sort of forms of scarce intangible assets, and in particular, network density. So that could be physical. You could own a company that has the densest network of convenience stores in a given geography, or it could be virtual, a social media platform or an embedded software provider. And so what it comes down to in some form is some form of density advantage, usually R&D, sales force, network. And that's not that different from a resource where you're looking at ore grade or CBD, where you've got a lot of wealth per capita, a lot of population density. And so in my mind is this linkage between density and incumbency, and businesses that kind of embody that appeal to us. And then we make a separate judgment about price. Does the arithmetic make sense? Can we see a path towards a reasonable free cash flow yield for a business that will participate in nominal growth over time because of its lock on a market? And that's how we get to scarcity and value.
Yeah, that's fascinating. And then just on that point around gold, we're pretty keen to unpack that with you because you're obviously well known in the market as being a large investor in both gold bullion and also actual gold miners as well. It's a space we sort of know quite well in Australia, given the ASX is a lot of resources companies. So I guess first question on this, maybe do you want to discuss holding bullion versus the gold miner and how you think about that?
So gold for us, in some ways, exists in the context of our portfolio as a potential hedge. So we're quite variegated in the nature of businesses we'd own. Almost like if you were curating a garden, you would have lots of different pockets of interest, not just one variety. But because we're mostly business owners and we worry about the financial architecture, which we can touch on later if it's of interest, we do have a potential hedge in gold. And in some ways, gold is the embodiment of scarcity value, the same way we would seek that in a business, but in a physical asset. And the paradox of gold is its utilities and its uselessness as a commodity. It's chemically inert. And that means that unlike copper or oil or iron ore that are useful, their prices will trade up and down with the business cycle. Gold, given its inertness, tends to be a much more defensive asset and has far less correlation to equities and risk assets. And because of its inertness, it's a natural perpetuity. It lasts forever. And so gold's density makes it cheap to store, and its inertness gives it a low beta. And so we've gone through the periodic table the same way we go through a list of 1,000 stocks and tried to find a better real asset as a potential hedge and can't find one because it's the embodiment of those values. And our feeling has been that because of its density and its low cost of capital, because it doesn't have much beta, it's one of the only real assets that makes sense to store physically. And I guess the leap for us, and it really happened under Jean-Marie, was that if we're willing to own gold in a vault, we should be willing to hold it in the dirt via a miner if we can get it a lot more cheaply. And so we're open-minded to looking at miners or royalty and streaming companies if there's a valuation margin of safety in the runoff value of their resources relative to gold. And then obviously you need to make a judgment on whether management's going to get the gold out of the ground in an efficacious way.
So there's a few nuances there that you sort of touched on, like the operational considerations of owning a miner, as well as just the fact that gold in the vault but it doesn't get any more aligned with the scarcity value piece. That makes sense. And then I guess sort of moving through a couple of the other stocks, Will, I think there was a couple that you'd identified that you thought could be interesting to unpack. So
I think the first one that we saw that you have quite a large percentage holding in is Process NV, which is like a e-commerce play, and they're based out of a Scandinavian country. Is that right?
Well, they're actually in the Netherlands. It's a holding company that's listed in the Netherlands, and this is a good example of virtual density, as we sort of talked about before. The origins of process were that Naspers bought over 40% of Tencent over 20 years ago, and that was one of the great tech investments of all time. Tencent, you may well know, is sort of the leading social media gaming instant messaging platform in China. It's deeply embedded in the fabric of the online existence of the Chinese community, and that's been just a tremendous business over the years. And then Naspers spun out their international holdings into this Dutch listed holding company. That was about 6 years ago or so, and that became Prosus. Now, what's interesting to us is that over the last couple of years, the Chinese tech stocks were very out of favor, and this led to a dramatic derating of Tencent. It had always traded at a huge premium, but at its trough, it was available at a very attractive free cash flow yield, and the management team of Tencent was focusing on simplifying the business and improving its operational efficiency and starting to buy back stock. Why did we buy the holding company, though, in the Netherlands? It's because the holding company traded at a 40% discount to the value of its Tencent and other holdings. So in addition to Tencent, it owns the leading online food distribution company in Brazil. It owns the leading online classifieds business in Eastern Europe, and it has some online payments and fintech businesses in India. So it had this very interesting collection of businesses, but the holding company traded at a very large discount to the value of its holdings. And at the holding company level, the chairman there, Koos Bekker, who's a legendary investor who made the original Tencent investment, made the decision to start buying back stock in the holding company. And so taking advantage of that double discount, if you will. And so we saw a combination of great business, discounted price, and a management team that was adding value through its capital allocation.
Wow.
That's fascinating. Yeah, so you almost got your hands on, pretty, almost, I don't want to say it's like a growthy asset, but like, sort of, but at a value price.
At a value price.
Yeah.
I think this is a key thing to understand in investing, that you make money if you identify an asymmetry between price and prospects.
Yep.
It's not good enough to identify good prospects.
Yep.
You have to find prospects that are unpriced. And so the best investments for us have typically been those where you're buying a business that's priced like a bond, because it's out of favor for one reason or another. So you're getting that growth optionality for free, and that's the key element.
Yeah. Wow. And were there many other managers that was like, it's just doesn't seem like the most sort of mainstream, printed or business that's typed up in the Wall Street Journal on a day-to-day basis. So
no, we at First Eagle we get excited by eclectic royalties, and so if you look through our portfolios, often there's quite an eclectic group of companies.
Yeah, interesting.
Yeah, it's interesting. And then just back on that point around, finding things that are potentially like mispriced or unpriced. When you see the rise of passive investing and, this sort of trend where people are parking money in ETFs that are just passive funds, what's your take on that? Because that's been quite a big thing recently. And then you've seen obviously the Magnificent Seven driving the majority of the returns of very large indexes like the S&P 500. Is that potentially dangerous because these passive funds are almost valuation agnostic? Is that a bit of an issue?
It's a plus and a minus. I think what passive funds have done is enable, in some ways, the democratization of equity markets, where people can benefit from the risk premium that's on offer at low cost without having to make a judgment about the kind of manager they might deploy capital with. But you're correct that when you own an index passively, you're abnegating any judgment around valuation, around management behavior, and around business cycle risk. And so you have to feel comfortable that if you're going to go passively, you're going to be exposed to the episodic bubbles that occur in markets. And Japan was the largest country in the MSCI world back in the late 1980s, which is hard to believe today. First Eagle at one point in 1989 didn't own any Japanese stocks because we couldn't find good businesses at good prices. The tech mania in the late 90s, again, we had very little holdings, but it became the biggest sector in the market because of enthusiasm. And then financials were the biggest sector in 2007 before the global financial crisis. And we had very little exposure there because we didn't see the margin of safety in balance sheets and management behavior. People got very enthusiastic about the BRICS a decade ago. We had very little investment there at the time. We now find emerging markets quite attractive. And in the wake of COVID, everyone was piling into bonds at zero or negative yields in some areas, and we were going in the opposite direction, wanting to own more gold. And so I think you just have to be conscious of the fact that if you're going to own an index, you'll be exposed to the pockets of greatest enthusiasm. So it has its benefits and it has its risks. And one of the confusions in the investment management business, I think, is that a lot of people view risk management as trying to have low tracking error to an index. But tracking error is just a statistical construct. You equally weight the upside and the downside. What really matters to us is avoiding the permanent impairment of capital in real terms. And so I guess we view active management firstly as a risk mitigation exercise. And in order to mitigate risk, sometimes you have to be willing to look quite different from a passive index.
Yeah, I think it's one of the things that stuck with me from my very short experience in investing my own money is don't lose money, and that's so it's interesting to hear that even from sort of at the big end of town, limiting the risk of impairment of capital's a core focus of yours.
For sure.
I guess just related to that question, another big thing we're seeing recently is like the rise of these quant AI strategies where, you're almost trading off like a more technical view, like in terms of like price movement, volume, stuff like that. And a couple examples that sort of stuck out to me in Australia is these two companies in the tech sector. They released earnings, share price dumps on the open quite dramatically, like 10-15%. And then when the company comes out and explains these numbers in their investor presentation, the stock ended up the day plus 5%, one of them, and the other one ended flat. And I'm just curious because the only thing that really explains that in my mind is you've got some AI tool that's picked up these numbers and gone, that's a miss on consensus earnings, and then so we're selling at the open, and then you see it recover. Are you seeing that here? And sort of what's your take on that? And do you think there's a place for these AI tools that can potentially do that?
Look, I think quant has sort of bled into AI because they're kind of related, and some of the great quant managers are increasingly using AI to scrub data or to find additional sources of data that may not be in just raw financial statements. I think one of the things that's key to understand is that quantitative/AI strategies tend to be high frequency strategies in nature, because you're essentially identifying what you think is a small bias in the coin and trying to flip it many times to magnify that informational edge. And you can understand this in the context of just normal investing. A traditional quant strategy might rank the market by price to cash flow ratio or by expected growth and or momentum, and it would buy the cheapest decile or the highest momentum decile. But by definition, stocks are coming in and out of those deciles quite regularly, so it's a higher turnover approach. I think on the other hand, when I think of active management, practiced, think of Buffett at one extreme. He's almost buying to hold indefinitely, and so it's a low frequency strategy.
Yeah.
And so the kinds of factors that one might weigh are quite different, I would say, in many of these approaches. The other thing that's I think interesting to note, and we'll sort of see this play out in one form or another, is that you have to distinguish between data mining strategies that are based on just inductive search for patterns that fit versus deductive reasoning. which develops a hypothesis about why the world should work a certain way, and then sees it play out. And the risk of a purely inductive approach is that you find patterns that are transient. And there was a great book written that was recommended to Warren Buffett to the partners of Goldman Sachs, called "Where Are All the Customers' Yachts?" And the name of the author is elusive at the moment, but it was written in the 50s, and it was a parody of Wall Street. And it said, in every generation there's going to be some young Turk who finds the pattern in the roulette wheel, unfortunately for him. I think some of these strategies will survive the test of time. I think many will fail because they're elaborate data mining exercises that are high frequency in nature.
Interesting. And sort of coming back to a little bit of strategies that have stood the test of time, and some of the great investors, like you've mentioned, Buffett, but there's a book that Will and I have both read. I've actually got it in my bag over there. Richer, Wiser, Happier. Yeah. And you're profiled in that book, which was authored by William Green. And yeah, I strongly recommend reading it for anyone who hasn't. And you're profiled along the likes of Charlie Munger, Howard Marks. Sort of what did that experience surface about your own edge, and what common threads did you notice throughout the other people and yourself that sort of brought you guys together in that book?
One of the things that interested me in that book is that many of the managers profiled had a fairly prudent DNA, but I would say there is a bit of a distinction. A lot of the writing was about managers who are looking to concentrate their portfolios in their best ideas. Yeah. And that's really a wealth maximization strategy. And I think when people think about investing, often they go straight to this notion, well, I'm doing it to have this great wealth maximization moment. I think as I sort of thought about who William profiled and perhaps how we differ a little on that spectrum, is that intrinsic in our approach is a great deal of respect for entropy and complexity. And we're very focused on fade risk at the micro level. This notion that every business is a melting ice cube. And so you have to be attuned to the fact that having variegation in your businesses and the kind of incumbency that you seek is important. But we're also very focused on complexity, which means that we probably, relative to a number of the other managers that are in there, intuitively think markets and the future is more uncertain than we think it is. And so if you're essentially doing a concentrated investment strategy, a wealth maximization strategy, you're expressing a high degree of conviction in how the future is going to play out. Mm-hmm. You're looking for the inevitables. On the other hand, if you think that there's an intrinsic amount of uncertainty, because businesses face substitution risk, sometimes not even within industries, but new industries get created that take the profit pool, you tend to be a little more diversified and focus on avoiding capital loss first and foremost. And so I guess I think where we have perhaps differed is that we've sought to deliver a satisfactory and attractive real return over time, but subject to having more ballast or more protection in extreme market crises. And the reason I mention that is that we have over 2 million ultimate investors in our mutual funds, and so you're trying to keep them with you for the compounding journey. And so I think you have to distinguish between investors who are investing just their own money, who can afford to take large amounts of concentration risk, and investors who are investing other people's money and who want to keep them invested for the compounding journey. And so I think there's some of that nuance that comes out in the book, but I think it's a great book, and I think William is a tremendous interviewer and thinker, and I think when I think about our network of senior advisors at First Eagle, we love people who, on the one hand, help us with our analytical toolkit, but on the other hand, who help us with temperament. And I think William is a great student of temperament. He's written about it for decades.
Yeah, no.
So, sorry, you go.
Yeah. Oh, no, you go, mate.
Oh, yeah. Just like, so do you get William in ever to speak to the team?
So after I went through the process of being interviewed by him for the book, I thought, I hadn't really had an interview process that in-depth, with that in-depth research that William had done. I was very impressed, and I started to spend some time with him because he was doing these deep dives on a range of other investors and obviously published his book. And so I've built a great relationship with William over the years, and in fact, we as a firm now have a relationship with William where he occasionally will bring in a very interesting investor to speak to the team.
Oh, awesome!
So you're learning about how other investors think about the world and how they make the kind of judgments that we've been talking about today. And William's really at the center of a network of interesting thinkers, and so he's become a very valuable source of insight and just a great friend over the years.
Yeah, it's interesting how you think about and in your role, you've always mentioned key people that you've sought to learn off, bounce ideas off. I think you mentioned Don Hampson and Paul Farrell early in your journey, and then as even people who aren't necessarily investors themselves but work with a lot of other investors like William. Is that always been something you've sought to have? Is those key people around you, like in terms of mentors? Even in at the end of the day, like we sit here and go, you're probably one of the best investors in the world. Even for someone like yourself, knowing that you're not going to have all the answers, it's interesting.
The job of investing in some ways can be quite lonely because you occupy the geography of your own mind, and you spend a lot of time in deep reflection, trying to make sense of the world and trying to see things that other people may not see. But I think as you go through the journey of developing your own mental toolkit, I think you over time realize that, you get humbled by markets at different moments, that you can't possibly know all the answers, and so you surround yourself with thoughtful people, and it's almost like the notion of having your own personal board of directors. Ultimately, you've got to make judgments, but why wouldn't you surround yourself with people whose judgment you respect?
Personal board of directors.
That's smart.
That's a great idea.
Need to start building ours out.
Yeah. You're not making the cut, mate. Let me tell you.
So yeah, just on because I just sort of said just before as well. Like you're trying to see things in the world that others may not be seeing. Do you keep like a decision journal or some sort of record of where you've sort of made key investment decisions and how they sort of panned out? And then is it then a case of pattern recognition in the future where you're like, I've sort of seen this before and how this plays out, this type of business, this type of industry, and then you sort of know when to go or not?
It's a great question. I think if you were a scientific researcher, you'd make a hypothesis, you'd test it, and you'd analyze the residuals.
Yeah.
And I enjoy playing backgammon. I was playing backgammon yesterday against one of our portfolio managers. I was on the golf line. He beat me 5-0. But the only way you get better is by studying your mistakes and looking for the patterns in those mistakes. And so what we do at First Eagle is that we have an annual offsite where we bring the entire team together. And part of that offsite is a post-mortem where we basically look at the stocks that were the greatest sustained contributors to our performance over time and the stocks that were the most disappointing. And we look for the threads of continuity in those tails of the portfolio. And I think it's fair to say that when you look at the stocks that have been most disappointing over time, there are some patterns that emerge. They tend to be businesses that face more substitution risk. Now, obviously, if you're buying a company that only has 2 or 3% market share and has a lot of competitors, you know that going in, right?
Yeah.
It's trickier when you buy a company that you think has 30 or 40% market share and has incumbency advantages, but where a new industry gets created. So sometimes it's substitution from outside the system that you've studied that's most humbling, and so you've got to be attuned to cheaper and better happening outside the direct industry. And one of the other things that tends to be a recurring theme is when management teams hoard capital and they don't reinvest it thoughtfully. So it's one thing to have a high earnings yield or a low PE ratio, but if the management's taking that free cash flow and doing silly things with it, it's kind of a corrosive toxin over time. But we do the equivalent of a decision journal through our post-mortem process, and I think that's the greatest way to learn.
Yeah, fantastic.
Yeah. And then on the new industries point, you can't obviously control these exogenous impacts on a business that might, internally be very well run. I guess an industry that we find very interesting is probably because in our lifetime, it's probably the biggest change we've seen is like AI and everything around that. A business that's just done there's a business that is on a big raise in Australia that's an AI infrastructure company. It's just hard with these new industries. They seem to immediately trade on these frothy multiples. I'm just interested in your take on how, if you even can, own these sort of new industry businesses early in the cycle, or whether it's sort of something you have to see play out before you invest, or whether you can even get in perhaps before it's seen as the new industry. Yeah.
I think it's extremely difficult because the weight of investors want to own the new thing.
Yeah.
And so the competition for identifying that is very high.
Yeah.
And the valuation that people are willing to pay is typically reflective of the upside skew that they perceive. So you run the risk a little bit of buying a lotto ticket where if you get the winning number, it's going to pay out well, but maybe your expected return is a loss. And it's a really difficult thing to do. We talked a lot about this notion of incumbency, scarcity of market position. Sometimes it takes a generation for a market position to solidify. And Warren Buffett made the analogy some years ago. He said, look, when the automobile was invented, you knew it was going to be huge, but you had no idea if a natural monopoly was going to emerge, or whether one company would take the profits. You did know the horse and buggy business would get more difficult. This is Warren Buffett's point. And I think the key point I'm trying to get across is that it's not just that you're in a growth market. You have to feel comfortable that a company will own the lane, that they will have an embedded market share position. And those judgments are exceptionally difficult to make early on. And the final thing I'll say is, like, if you're in a rapidly growing business, someone has to manage that process of growth. Humans only have a certain amount of bandwidth to deal with complexity. If you're trying to run a business that's growing at 40 or 50% a year for 5, 6, 7 years, most people's brains explode. There's just too many variables to manage. And so it's not just about a company that has a unique product, but you have to find a manager who can manage that complexity. And those are, I think, very difficult judgments to make in the absence of price. And when you add in the fact that most of these things trade at high prices, the odds become daunting.
And it just comes back to your point all along. There's a place for people to invest in that manner if that's their skin. But
yes,
for you in your role, scarcity value is your skin.
It's a great way of putting it, because I have huge respect for people who've done well in the world of venture investing. It's just so hard for me to conceive of me doing well in that space that I leave it to them.
Probably comes back to your good days under Don at UQ and learning the core principles of what drives you today. And I guess sort of one question Will and I always like to round our discussions out on is what is one piece of advice you would give to a younger version of Matthew McLennan?
That's a good question. I think that when you grow up through high school and college and start your job, you're very much wired on an annual cycle time. And when you're going through a more predictable phase of that development curve, going through college or whatever, you get accustomed to doing well if you put the effort in. And then when you start working in a professional scene, the dynamic just becomes more complex. And some of the skills that you need to develop don't necessarily develop within an annual cycle time. And so there can be moments in a career where you're just working for a very difficult boss, or the business that you're working for is out of favor cyclically for a few years. And I think if I could go back and advise myself, it would be to sort of focus less on what's happening in any given year and to focus more on, are you nourishing your human capital and just focusing on excellence and learning as much from the people around you as possible. Because I think, ultimately you're going to do well in your career if you're, from a mental model standpoint, a compounding machine. And it's hard to predict in advance whether you're going to be able to monetize that mental model at T plus 10, T plus 15, or T plus 2. But I think moving away from annual cycle time, the annual reviews, and the immediacy of success, to thinking about, what is the mental garden you're trying to cultivate, and really focusing on that.
Fantastic.
That's interesting.
great note to end on, Matt. And thank you so much for your insights. We're incredibly humbled to be here in your offices and getting a great view firstly, and then probably more importantly for our own self-nourishment and journey, getting the insights of one of the world's best investors. So thank you very much.
Thank you, and thank you for the thought-provoking questions.
Well, thank you, Matt.